This morning we will do a presentation to you. The presentation will be done by Alwyn from Merwe, who many of you know very, very well. He's our Director of Investments. Maybe just to give you a bit of an update on Sanlam Private Wealth over the last 3-4 weeks. Obviously, when the announcement came out to work from home, we moved roughly about 240 people from our business to work remotely from home. We have very few key staff in the offices that do trading on a daily basis. But all our portfolio managers, the more than 80 that we have in the business, work from home. They can trade directly from home. They have access to all the systems. So for us, it's very much business as usual. We have every morning, we start the day, Monday to Friday, 8 o'clock with our normal morning meetings where all 80 portfolio managers dial in. We debate the markets, all the analysts who cover specific companies when the results come out or when sense announcements come out or there's specific market news that comes out in America or Asia. We debate that in the morning. We decide what the implications might be for some of the portfolios that we manage for you as the clients. All our portfolio managers participate in that. So please make sure that you keep talking to them, that you speak to them. But for us as a business, it's very much business as usual. And hopefully all of you have experienced that over the last 2 to 3 weeks. From a bigger Sanlam perspective, I'm also pleased to announce that we've, together with our big empowerment partner, Ubuntu and Patrice Motsepe, donated more than R1 billion to this COVID virus, to that solidarity fund, to make sure that we as a company assist South Africa in getting through this tough environment. So we're very pleased to be part of that, to support that. For my personally, through this presentation and through what Alwyn will talk, we will cover the macro environment, South Africa as well as offshore. We will cover the way we look at our investments in that environment, what happened to asset prices globally and in South Africa, and is this a good opportunity to invest in those markets? I know a lot of you are very anxious. I know you have a lot of pension money that's invested with us. I know you ask a lot of questions. I know there's lots of information throughout daily through all the different daily news bulletins. So what I'm going to try and do in this presentation, just to give you comfort around our investment process, the way we look at this. And I think you will pick up through this that if we do think it's maybe a good opportunity to add a little bit of risk to those portfolios, but hopefully we will give you all those answers. Personally, I think I see this crisis and economic impacts in two parts. I think globally, a lot of volatility, significant amount of bad news and results will come out the second quarter. Markets reacted very quickly. We've seen a recovery, which Alwyn will talk through. But I think we're not sure where that recovery sits, but I do think with all the stimulus through the different developed economies, you probably might see a faster recovery. South Africa, unfortunately, a different story. We come out of a very, very tough 2 to 3 years, very difficult fiscal position that we're in. I think the only tool available in South Africa is the lowering of interest rates, which they've done. This lockdown is putting us in a more severe recession. Some of the information out there is that basically the first 3 weeks is minus 2.5% on our GDP. Another 2 weeks will add to that, and Alwyn will talk a little bit more through that. So I definitely think the asset prices has come down a bit more in South Africa. I think it's going to take us a little bit longer to recover, but in there, I think there's significant opportunity. So Alwyn, over to you. Thank you.
Good morning, Carl, and thank you very much for the introduction. Good morning, ladies and gentlemen, and thank you very much for engaging with us from wherever you are in your house or your home. I'm sure, just like us, you have many questions about the impact of the coronavirus on the civil society, on the economy and economic activity, both in South Africa and, of course, the rest of the world. How that will have an impact on financial markets, and then more importantly, from our relationship with you, how does that have an impact on the way that we run your portfolios? So what I will do is I will take you through a presentation where I try to address these questions by using a slideshow. So if you just bear with me, I just want to share the screen with you. Carl, can you see the screen?
Yes, we can see the screen. So all ready. Thank you, Alwyn.
Right, I think despite the fact that we've seen many of our clients in the first week of March, it would just be good to address these questions from a portfolio management perspective and tell you where we were in January and how we saw the world in January. So then you will understand that the actions following the fallout of the coronavirus, there's context for that, because we don't start with a blank sheet. We start with an existing portfolio and views that were held in those portfolios. So many of you as clients who've come to our seminars over the years would know that when we structure portfolios, the most important issue that we take into consideration in the structuring of those portfolios is price. So normally when prices are expensive, we would argue that you should have less of that particular asset. And when prices are cheap, we would argue that you should have more of that particular asset in your portfolios. So if you go back to January, we said that if you look at equity markets globally and certainly also locally, we said that the valuations were elevated, but certainly not in a bubble territory. Now remember that we made the comment from a global perspective after we've experienced a 10-year bull market for global equities. So despite, unlike other cycles, this particular bull market did not end in euphoria. In other words, the valuation of equities was certainly not in bubble territory. Yet it was elevated, as we said, and therefore we argued that we should have, in multi-asset portfolios, we should have a neutral to an underweight position in equities. And in equity-only portfolios, you would have seen that there was a bit of a cash balance in those portfolios. So we took on slightly less risk, given the fact that we thought that we had that the markets were elevated, but certainly not in bubble territory. If we look at perspective, and now I refer to the economic story associated with asset prices. If we look at perspective, we've said that just as we had a 10-year equity bull market, globally, we had an environment where we had economic activity advancing for 10 years uninterruptedly. And that was one of the longest extended periods of increased economic activity across the world. The way we've described it was, we said it was a mature kind of upswing in economic activity, yet unlike other cycles, we couldn't identify a lot of pressure points that will bring the cycle to an end. And one of the other reasons why we thought that there was no need for a collapse in economic activity is that, unlike in other cycles, we haven't really seen inflation cropping up. So there was no need for monetary authorities to hike interest rates and kill the cycle. In fact, the opposite has happened. If you go back to December 2018, you've seen that the Federal Reserve has in fact embarked on a process where they've reduced interest rates during 2019, and equity prices responded to that. And then finally, if you go back to the pattern of financial markets, equities were in a bull market. And because it was a mature bull market, again, we've argued that although we don't see a collapse in prices, we just know that the longer the bull market continues, the higher the risk, because they can't continue forever. And again, from a portfolio management perspective, we certainly said that you should just have less risk. Now, as I said, I spoke about the cash balances in the portfolio. We increased the cash balances. And if you, in the equity-only portfolios, what we've also done to reduce the risk is we actually trimmed some of the what we call more cyclical equities. In other words, some of the mining companies that where the share price normally displays a more cyclical pattern of behavior. So if you look at what we've done is we've positioned the portfolio slightly more defensively compared to some other people in the market. Yet, and I've got to be very, very clear on this, despite the defensive positioning, you can never be defensive enough if you are being hit by external shock of the nature of the coronavirus and the fallout that created within the economic arena. So we thought we were okay, but of course you can clearly see on the balances of your asset portfolios that we run on your behalf that unfortunately your portfolios were not immune to the sell-off in risky asset prices. So that is as an introduction. I just want to, again, and it's a bit of a philosophical issue, and maybe I should just only focus on the latter two. I spoke a lot about the long-term trends of markets, and that is the only trends that we think should take into consideration when we position client portfolios, because it's the only trend that you can consistently bank on. The other day-to-day movements, they are very random, and it's impossible to take consistently decent decisions on them, and we often just refer to those as noise, and we try to ignore it. As clients, we fully understand that you are exposed to the daily noise by watching TV, by reading newspapers, by watching CNN. That is unfortunately how it is. But then there's a third component that often happens in financial markets, and that is a component or an era where one or two things happen. On the one hand, you can get, on the upside, you can get manias. So people get so excited about a particular story that changes investor sentiment, and greed takes over, and it pushes prices into the stratosphere or into what we call bubble territory. That is what we call, that has been driven by the investment emotion, greed. The opposite is also true. You can get an event where the news flow is extremely negative, and that triggers the emotion of fear, and investors take emotional decisions by selling assets below the true value just because the story or the event creates that emotion where you say, I just want to be safe and I'm prepared to go out of it. Now, of course, what we've experienced since middle February is exactly that, where the coronavirus has triggered this emotion of fear, and clients, or not clients, investors have decided they don't want anything to do with it, and they wanted to invest in safe haven assets. As a result, that sell-off created mayhem in financial markets, and we've seen prices drop materially during this particular crisis. So what I would like to do is I would like to explain to you how we think we should treat this event in client portfolios, and how you as clients, hopefully in partnership with us, can think about your portfolio. So I just quickly want to give you the picture of what has happened in the crisis. Now, global equity prices peaked on 20 February this year. And if you look at developed markets, this has been reflected by the blue line on this graph. These prices peaked on 20 January. The prices collapsed within a month. So if you look at the S&P 500 on the 23rd, did I say January? It should be February, 20th of February. So on the 23rd of March, those prices hit a bottom. And in the case of the S&P 500, that was 34% down from its peak recorded on the 20th of Feb. You would agree with me, it was just a free fall if you look at the pattern of this particular graph. So if you were there, you had very little opportunity to sell assets, because the initial fall was just an extremely rapid event where investors just fled for the hills, to use that term if you don't mind. The black line gives you an indication of what has happened to emerging market equities, and you can see that that the correlation between the two lines are quite obvious. Since the 23rd of March, you can see that there was quite a substantial recovery in share prices in the world. And in the case of the S&P 500, after the initial decline of 34%, it scaled back 27%. And if you look at it today, it is down about 16% from, in dollar terms, from its peak. If we add South Africa to it, you will see, despite the fact that we've always argued that the South African market was less expensive or not as elevated in terms of valuation relative to overseas markets, the fact that we were less expensive certainly didn't shelter us from the negative investor sentiment. And in the case of this blue line, and this is all now in Rand terms, the South African market collapsed by 36% over exactly the same period. and then we had a decent bounce. Our market is up by about 30%. And if you look at it on total from top to bottom in Rand terms, our market is down by about 16%. So strong decline initially and then a bounce. And one can argue whether this bounce that we've seen, whether that bounce is sustainable. The last point that I want to make on this slide, and it's perhaps important for you as clients, and it's a throwaway comment, but we often argue about diversification and geographical diversification. If I update this blue line, this slide is a week old. The blue line, in fact, sits where my arrow is on the slide now. So in Rand terms, global equities are now at the same level, if not higher, compared to when the crisis started. So it tells you that the weakness in the currency protected at least the Rand value of global equities. Of course, in dollar terms, I've explained to you what the case is. But again, it shows you the benefits of diversification. And sometimes, and I know we haven't seen it in the last 7 years or so, sometimes it also benefits to be in South Africa rather than overseas. As I said, it didn't help over the last 7 years. When you get a severe sell-off, the one asset class that, if I may use investment terminology, that acts in an uncorrelated way is global bonds. So what you see in this case, and if you focus on the blue line, it's perhaps the easiest. These are the yields generated by 10-year US government bonds. So the higher the yield, the cheaper the bond. And you can see from February, you've had a significant decline in bond yields from about 1.6%, if you look at the left-hand scale, to about 0.4%. That means that the prices of US government bonds went up when equity prices sold off. So we've seen exactly what you would expect from global bonds, that again, it acted as a safe haven for assets and it performed quite strongly and it protected people against further fall. So in multi-asset portfolios, you would recall that we have some exposure to this. We preferred cash in global portfolios, and the reason for that, of course, dollar cash would also protect you. But if you look at the yields that you get here, if I buy a government bond yield now, look at that blue line, and I go with my arrow across, so then let's say a 10-year government bond yield in the US is now trading at 0.7%. So if you buy it and you hold those assets for the next 10 years, it means that your return in dollar terms will be 0.7% per annum for the next 10 years. I think you would agree with me that on a prospective return basis, this doesn't make a lot of sense. So if this particular asset doesn't have another function in the portfolio, I find very little reason why I should hold it. And the other function is it does provide you, it does act as a buffer in times when you have a crisis in markets. But again, just remember that number 0.7. I will refer to that later on in the presentation when I talk about other asset classes. So I think that was how the world worked. Gold went more or less sideways. So the gold price didn't really go up. In fact, it went down initially and then went up. So if you look at it through this period, the gold price actually went sideways. I want to talk about how we take decisions in this very uncertain environment. And what I'm going to do in the rest of the presentation, I will touch on our view on the local economy and global economy. And I will talk to you about the uncertainties. And of course, most of you will recognize that it is extremely tough to forecast not only the growth rates, but the path of economic growth that we will experience over the next year or 5. It is very difficult. Having said that though, if you run other people's money or you manage other people's money, there's never a single moment in the market where we don't encounter uncertainty. So uncertainty is part of the landscape in which we take decisions. There's sometimes just more and sometimes less. And when we do have less uncertainty, we can take more bold decisions. If there's more uncertainty, you would agree with me that you've got to be a bit more cautious, except, and this is a very important point, except if the prices already reflect a lot of uncertainty. Then the prices in our mind have already discounted a lot of uncertainty, and we can be more bold in the way that we construct a portfolio. So for us, it is all, if you look at the third bullet point, it is all about building sustainable long-term portfolios. And that is a combination of managing the uncertainty and combine that with the price behavior that we find in financial markets. So I quickly just want to talk about South Africa. I can give you the bottom line in terms of how we see it. I don't think it should be a secret, or it's certainly not a mystery. If you look at the South African economy, on this particular slide on the right-hand side, I just show you the GDP growth numbers, and it goes back to 1980 in this case. So GDP is gross domestic product, so it's just the size of the economy. And if you look at the blue line, which is the easier one to follow, it is just a longer-term trend. So you can see during the 2000s, we had a period of very strong economic growth. It peaked at about 5% in 2007, just over 5. And then you can see how the trend has just faded away to a point where it's now touching zero. So the question is, well, and of course, the reason is quite obvious. The economy was mismanaged by the current political regime. I don't think we should beat around the bush. We had poor policy decision-making from the political regime, and that ultimately introduced a pattern where economic growth just faded away. Of course, now this crisis will put an additional burden on the local economy. So how do we think it's going to play out in terms of economic growth? We simply think that the economy is probably going to shrink by about 7.5% this year. Put it differently, a growth rate of minus 7.5. Put it more differently, or trying to make it practical for you, if we produced 100 units in the economy, at the end of the year, you will see that the economy would only be in a position to produce 92.5 units. That's all. So that is what it means. But of course, there are other things as well. Quickly want to tell you that, you can't really change that. The lockdown and all the side effects of the lockdown will probably lead to that. What the government can do, though, the government can provide a buffer or create a base from which the economy can grow into 2021 and 2022. And unfortunately, the way they will need to do it is to introduce measures to stimulate the economy that are substantial. Not mediocre, but substantial. What does that mean? I hope, and I see that Cyril will talk tonight, or address the nation tonight. I hope that the measures that they announce will at least amount to about 2% expressed as the size of the economy. In other words, don't come with a package that is only 0.5% or 0.75% of GDP. What is happening in the economy as a result of the lockdown? People will lose jobs. If people lose jobs, there will be less demand. If there's less demand, there's less production. If there's less production, people will, the supply side or the manufacturing side of the economy will retrench more people, lower demand, etc. And you can see the cycle. That is normally how it works. If you don't address that vicious cycle, then that will continue. If you address it, it means you throw money at the problem, you get the banks to be part of the problem or part of the solution, you keep the financial system open, and you provide support to the banks to give that support to businesses, etc., and households that are in trouble, and that hopefully you can get out of that. If you do that, though, it will mean that your fiscal position will deteriorate even further, because you will have to get help from somewhere. And when that happens, this is what you will see. The way we calculate, let's say, the fiscal health of a country is you look at the deficit or the surplus, the budget deficit or the budget surplus relative to the size of the economy. And if you look at this particular slide, if we get meaningful support from the government, fiscal support from the government, it will mean that this blue line, which reflects the budget deficit, the shortfall expressed as a percentage of the size of the economy, that will go down to minus 13%. Ladies and gentlemen, I've never seen that in my life. So that will bring certain issues to the fore, but nevertheless, that is what we need to keep the economy going and to ensure that we get out of the vicious circle into something that is more positive. Okay. Normally the barometer of the health of the economy is the exchange rate. And the blue line here on this particular graph shows you the rand-dollar exchange rate. And you have seen how the rand is depreciated. And of course, the credit downgrade had a lot to do with that. You can see it's a free fall. I should have put this, turned this slide around so that you can see the fall and not, it appears as if the rand is strengthening here. In this case, 18 or 19 means it is cheaper. So it's 19 to the dollar, between 18 and 19 to the dollar. This has got important portfolio implications and it's got important economic implications, this particular number. Let's talk about the portfolio implications. Firstly, you will see it is not uncommon. Doesn't happen often, but it's not uncommon for the rand to blow out. It happened in 2001, and it happened there in this period where Jacob Zuma fired Nene at the time as the Minister of Finance. Back in December 2015. Now you can see it's a similar kind of event that we see. In both previous cases, if you want to, you can add 2009 in it. You can see that the rand blew out. The orange line is the number of standard deviations, the third standard deviation away from the theoretical value. And then the rand faded back towards the black line. Blew out, faded back, in fact strengthened way beyond the black line. Blew out, faded back towards the black line. So if you believe that history will repeat and it doesn't only rhyme, then I think over time you should accept that the blue line will over time fade back to the black line. Now many people don't buy that because they say South Africa, basket case, it's not going to happen. Ladies and gentlemen, what is important here is I think one would be naive to think that the fading back or the moving back, the strengthening of the rand against the dollar would happen overnight. There are way too many emotional themes that South Africa needs to face up that will, I think, prevent the rand to fade quickly back to its theoretical line. But if inflation doesn't blow up in South Africa, and as long as the Reserve Bank remains prudent in its policy formulation, our view is that that fading will happen. So this is exactly, again, why we say, please diversify, and why we say SA assets and global assets are not two opposite things. You've got to look at the best mix of those two things to get up, of those two asset classes, to get to the correct portfolio for you as a client. But if I'm a betting man, I would say that the blue line is likely to fade back over time. And the reason why I say that, and I just want you to focus on the third and the fourth column in this particular slide. Normally when the rand blows out, it does have inflation implications because remember, if we are a big importer of goods into South Africa, and it just means if the rand blows out, you're going to pay more rands for those goods, and that will mean that the prices of these goods, once you sell it in South Africa, are more expensive. Well, this time, what we've seen is two things. Firstly, the most important commodity, oil, that we import, oil, the price has gone down from 50 to 20 or below 20, depending on which oil price you look at. So that is not going to be inflationary. The second thing is local demand is absolutely muted at the moment. So you will find that the imports are going to be very slow to come into South Africa, so it will not have such a dire impact on inflation. And finally, on the local side, there's very little signs of pricing power. What does that mean? It just means that there's a lot of spare capacity in the local economy, so people can't push prices through. So what does that mean for monetary policy? It means it creates the scope for the Reserve Bank, despite the weakness in the rand, to say we are prepared to cut interest rates. And we've already seen that they've cut interest rates by 2.25% in this cycle. What are the investment implications? Well, firstly, the economic implications are that I think the currency is likely to fade back towards a higher value against the dollar. The investment implications are, if you compare cash against other asset classes, suddenly cash does not look like an attractive investment opportunity because you've just got a 2.25% cut from your previous levels of wherever they were a month or two ago. So that is South Africa. So it's not a great story, but I think, if the government comes to the party, we should get a recovery into next year. The world, IMF thought that the world would grow at about 3% in January. 3.5%, in fact, was the right number, if you look at the brown line. Then the event has hit us. Now, the question is, how will this economic world look past the fallout of the coronavirus? Now, you can listen to many economists, but I think sometimes it is quite sobering to listen to business leaders. And I thought it was very interesting what Mr. Jan Rupert had to say about a week and a half ago when he gave his comments or his observations in terms of how the events are unfolding. And it's interesting. He said, okay, first, he doesn't like, of course, it's very clear, he doesn't like economists. He doesn't think a lot about their contribution to the whole story. I felt a bit personally insulted, but I can live with that. Anyways, he said economists are discussing, and now he's talking about the economic recovery, are discussing whether the economic recovery will be V-shaped or U-shaped. And he says that is meaningless. So what we say as economists, economic activity has fallen like a stone. How will the recovery look? Will it come back immediately? So then it's V-shaped. Will it fall, stay flat, then come up, then it's U-shaped, or is it L-shaped, just goes down and then sideways? He says that is meaningless. He says the discussion should involve other issues. He said what they don't get is that this isn't just a pause. So it's not a letter of the alphabet. It's an entire reset of our economic system. And whilst I might agree with him on the last point, I think the investment implications will not necessarily change as a result of it. Why do I say that? Firstly, if I look at cycles over the last, or we as a team looked at cycles over the last 150 years, there were always different stories why you had an up cycle or a down cycle. But the one thing that you cannot argue away is that economic cycles has been part of the economic landscape for the last 150 years. And I think they will be part of the economic landscape going forward. The narrative and the actual structure of the economy might well reset. So why do I think cycles will continue to be with us? Because people are emotional beings and they take the decisions in terms of how they make an investment decision based on how they view the world. And if they are optimistic, they will invest money in a new factory and that will generate economic growth. If they are pessimistic, they will go back into their shells and postpone their investment decision, which will bring cycles down. So I don't think that will change. The other thing, and that is more important for you as a client, is what about financial cycles? Now, financial cycles I don't think will change because we will never get rid of the two words that are almost internal when you talk about investment cycles, and that is fear and greed. Psychology, emotions will still dictate financial asset prices going up and down. And when there's fear, it's normally a time to buy. And when there's greed, it's normally a time to sell. What you've got to do in both cases, please hear me out on this one, is still consider the price with the story. And when we say today that the prices that have declined, now the way that we look at it, we should think that normally when it's, to quote Buffett, when people are fearful, you should be not fearful, you should be greedy, and when people are greedy, you should be fearful. We would like to incorporate those thoughts in our portfolios, but please, we don't think it's a time to take extreme risks with clients' money. Time to take more risk, but not extreme risk, still continue to have balance in the portfolios. So just to complete the story on the global growth, IMF from plus 3.5%, they reckon the economy will decline by 3%. Compare that with minus 0.1% in 2009. So the economic fallout is likely to be bigger in this particular cycle. What does it mean for us? And if I can just leave you with one thought today, and that is what the debate is all about this morning, and the debates that we had within our team, with Craig, with Humphrey, and the whole lot, is what really matters is whether the price changes for equities, for listed property, for bonds, whether those price changes are proportional or not to the worsening of the fundamentals. So if the price changes were proportionately more severe than the worsening in the fundamentals, it means that we've got to put on our buying cap. Can I repeat that? I'll do it in simple English. If the decline in asset prices were deeper than what we think the economic fallout would be, then in all likelihood, the true value of these assets are higher than the market value of these assets. And then we should acquire some of those assets. That is really the call that we want to make. So let's look at the valuations, and maybe just briefly to put it into historic perspective. If I look back at all the bear markets that we've seen over the last 100 years in the US, and I've just used the S&P 500 in this one, and I say the average price decline in a bear market over the last 100 years has been reflected by this black bar, 34%. If you look from top to bottom, the US market within about 4 weeks, did minus 34%. So it is already, in that first 4 weeks, they've done what the average bear market did over the last 100 years. So a lot has been discounted in the prices. That is the first point to make. The other point is, if the economic fallout is more severe, you would think that the price fallout should also be more severe. And I think most people would argue we don't really know how big the fallout would be, but at least it's going to be very tough. The other point that you need to consider, ladies and gentlemen, and I think this for us is the important one, is what was the valuation at the starting point of the decline? Was it bubble? Was it just expensive, or was it marginally expensive? And the more expensive it was, I think you would agree with me, the higher the potential that this fall can be more severe. And as I've argued, and I'll show you now, is I don't think share prices were in bubble territory. They were slightly elevated, or they were elevated. So therefore, just on valuation, one shouldn't think that you should get a fallout as big as what we've experienced in 2001, where the market fell by 49%, or in 2007, 2009, where the market fell by 57%. So with this decline, again, I think time to add to risk in the portfolios. There you can see the valuation. I'm not going to, it's a technical chart. I've showed this many times to all of you in the Southern Cape and in KZN. It's just the prices of equities divided by the earnings, and the higher the number, the more expensive the market is. And you can see that if you look at the MSCI world, that we were sort of just above average in terms of the rating. And then, of course, as a result of the fall, you can see suddenly the PE multiple has declined significantly, not yet as cheap as it was in 2009. Another reason why we say add to risk. But boys, if you allow us to have 75% in equities, don't expect us to go immediately to the 75%. I think you've got to work with your risk budget a bit more prudently. The one factor that I reckon that will have an impact on the sentiment in the market is what is going to happen to forward earnings, or what is going to happen with earnings. And in the previous two sell-offs in 2001 and in 2009, the earnings decline. In other words, the financial performance of companies in the US declined by 15% in 2001 and by 40% in 2009. And that 40% decline also explained the bigger fall in the equity prices in 2000 and 2009. So the black line we've just started here, that is the current cycle. So if this black line is going to fall rapidly and a lot, we will still have a lot of very, very nervous investors in this market. If the black line, as a result of the response of the stimulus provided by monetary and other economic authorities in the world, does not fall as far as this dotted line, then the downside of the market, or the prospective upside, certainly looks more promising. I want to, if you don't mind, just spend a bit more time on this slide. It is a slide that I've showed before. To our clients, I know you know that you've probably worked in different walks of life, and you don't always fully appreciate these financial terms that I use. When a doctor talks, I don't understand what he's saying, because they don't talk Afrikaans or speak Afrikaans or English, so they speak medical. But if I can just highlight one or two things for you. The prospective returns, the future returns of any asset class, is a function of only two things. It is the rating of that asset class, asset class, and it's a function of the economic performance. In the case of equities, the profits that the companies make. The higher the profits, the bigger the return. The higher the rating, the bigger the return. And it's the combination of the two. So what we've done is we've built a model where we said, okay, if we look at the MSCI, in other words, at global equities, and we say, okay, they trade in 3 years' time, it will trade at a 14 times multiple. Now we've got to combine it on the y-axis with the earnings that the market expects. And the earnings growth that the market expects over the next 3 years is 11% per annum. That is the consensus. So that is that line. So if you work with that row and you work with that column, it would suggest that if earnings can grow by 11% and the multiple is 14%, you will get an 11% per annum return generated by global equities in dollar terms, which I think is great if inflation is going to be 1.5%. That is a real return of high single digits. Compare that with the 0.8% that you can get for bonds. So that is the first thing. If you say, well, they've smoked something, in this environment, we're not going to get 11% earnings growth over the next 3 years. Let's use 10% less. Then you talk 7% return if the market trades at 14. Even 7% when you get inflation of less than 2% is a 5% real return in dollars. And I think given the hardship that we in South Africa has gone through, many of us can live with that. Again, compare it with the 0.8% in bonds, should you hold the bonds until maturity. So I think there's a big enough promise for returns to engage in more equities globally. If I do exactly the same exercise for South Africa, I will go back to some of these slides, but I just want to go back to the same exercise for South Africa. South Africa, because we are a more risky market, you can't bank on a 14 price earnings multiple. The price earnings multiple should be more conservative, so that is 12. At the moment, and remember there's a lot of rand hedge stocks listed on our market. The market reckons, not our view, the market reckons earnings will grow by 16%. But again, to me, it feels a bit high. So I will say, let's work with 10% less than consensus. So that takes you to that row. Work on a 12 PE, 12 months, 3 years out, and you get a return in rand terms of 15% per annum. Let's say inflation is 4. That is 11% in real terms when you look at South Africa. 11% in real terms in rands when you look at South Africa. Compare that with cash, compare that with also the risk associated with bonds, and I think you would agree with me that you can take on some risk. I just want to show you one slide, and that is the price earnings multiple of South Africa, and you can see how that has come under severe pressure and is now at the same kind of lows which you've seen in 1998 and then again in 2008, 2009. The one point that I would just, and it's an important point to make, if you don't mind. One point that I want to make is I spoke about the decline in South African equity prices. Decline in South African equity prices was 36%. But a lot of that was buffered by very strong performance of the Naspers share price. Very strong performance of the Naspers share price. There I show that if you look at the shorter term. The black line is Naspers, and Naspers and Prosus together constitute 24% of the all share index. So if the entire index has fallen by 36%, but Naspers didn't fall as much, it means that the remainder of the market has fallen a lot. And one of the sectors that really, don't want to use the word because it's kind of a slang word, but really got smashed was the banking sector, for instance, where the banking sector was down 40%, recovered a bit, but it was down 45%, recovered a bit, but it's still 40% off its highs. So there are other areas when you manage your portfolio where we should say, if we just think equities, for instance, is there shares or are there shares that actually held up very nicely, maintained the values, that we can sell and create currency or the ability to buy other assets or other shares that are now much cheaper? And I think the answer to that is yes. Just the last point, and Craig, if you don't mind, I think it's a discussion that we should have with the Durban clients, but the one asset class that I just want to highlight as well is, of course, listed local property or local listed property. That sector has been absolutely annihilated. And it's not, of course, the assets are still there, and the assets, many of them are still excellent assets, but the balance sheets of some of these companies are under severe pressure, and one has got to be very careful that you don't include assets where the balance sheet will not survive the economic fallout. The asset might, but the balance sheet might not, and therefore the company might not. So one has got to be very careful and extremely selective in terms of how you handle that. So the portfolio implications in the multi-asset portfolios, we've added to equities, we've added again to equities. And I think that will take us to kind of a neutral, just above neutral exposure to equity market, both locally and offshore. And should the market pull back again, we will increase the risk. We reduce the cash holdings. Last year we got criticized for the cash holdings. We reduced the cash holdings to fund some of the equity purchases. We want to make sure that we've got 30% offshore in the portfolios where we can have 30% offshore. And then in property, you've got to be very careful, but it certainly looks cheap. So the thing is, you've got to put on your buying cap, but you've got to be extremely, extremely diligent in the work that you do on the underlying companies. So talking about diligence, I want to conclude the presentation by saying that, we understand that assets don't sell off if there's not a negative story associated with it. What we need to do as asset managers, we've got to make sure that the story, as I said on that one bullet point, that the story doesn't exaggerate reality. And I think that is, in the case of banks, our view is that that is indeed the case. So if you look at Standard Bank as an example of a bank, and I'll show you the rest now as well. This is the price earnings multiple of Standard Bank. And if you look at the far right, you will see that the price earnings multiple of the bank is 6.5 times. go back and look at the dates on the slide. It goes back to 1998. For those of you who've been around in 98 and involved in the financial markets, you would recall that in 98 we had the emerging market crisis where Russia defaulted on their debt. And what we found was that emerging market currencies came under severe pressure and interest rates went up from 18% to 25% in South Africa. To make it a bit more personal, in those days I was an investment analyst, and we had a long discussion with Michiel Leroux, who was then running the NBS Bank in KZN. Today, Michiel is the chairman of Capitec. And when we spoke to Michiel, we said, Michiel, how do you run the bank now? He said, I don't know because it's virgin territory. Well, it was in the price. If you bought then, you've made phenomenal returns on the purchase. It is now even cheaper. It's now even cheaper. Is the story worse? I'm not exactly sure that the story is worse than then. The question that I think one should ask is, and I spoke about that briefly when I spoke about the property counters in the portfolio or property counters in South Africa, is, are these balance sheets of the banks, are they strong enough to sustain themselves through a period of serious economic slowdown, where some of their debtors will not be able to repay their debt? Are those balance sheets strong enough? And the way that you measure the strength of a bank's balance sheet, you look at the capital adequacy ratio. Now, the higher that ratio, of course, the more capital it has got as a measure of contingency. So in the case of Standard Bank, and I've got all the banks here, Absa, Standard Bank, Nedbank, and FirstRand. First point. Secondly, the regulatory requirement is 9%. All these banks have got a significant margin of safety in terms of capital relative to the regulatory requirement. The one with the strongest balance sheet, of course, is Standard Bank, which got a 14% credit, capital adequacy ratio. Now, what needs to happen? How big should the fallout be before the banks must come to the market for additional capital? In other words, before the banks need to come with a rights issue and ask you and me as shareholders of them to give them more capital to beef up the balance sheet. Now, we've done a case study on Absa, because Absa, as you can see, the capital adequacy ratio, with Nedbank is the lowest, still very safe, or not. We will test for that. So we said, what was the earnings that Absa generated in 2019? In 2019, they generated just over 19 billion rands of earnings. 19 billion, can I repeat that? So if Absa makes a loss of 13 billion in 2020, that is a 32 billion swing in profits. Only then will their balance sheet be so weak that they need to come to the market for additional capital. We don't think that the economic fallout is that severe that we will get that. And you'll see today even the bank prices are under severe pressure, and the market doesn't buy our argument. However, we think that we should look longer term, and when there's a new norm, whatever that is, we think that these prices are simply too cheap. Just another valuation indicator for banks is the price to book ratio. And you can see in the case of Absa, that is the brown bar, the price to book ratio now is 0.6%, which means that the value, the market cap of this counter is now at a 40% discount to the book value of the bank. So those are banks. So we think we need to add there. Where can we trim a bit? Where we were on the right side of the curve. We think that we can trim British American tobacco. Now, there was almost an outcry in Stellenbosch when we communicated to clients that we will trim British American tobacco, because you can just understand. It's a global company. It's been an extremely defensive company. So why on earth would you like, and the share price is going up in the time of a crisis. So why would you like to sell this asset? Well, we think we should manage assets on your behalf actively. Doesn't mean that we're trading. Just think that, you buy things when they're cheap and you sell things when they are either expensive in nominal terms or in relative terms. Now, this slide, this blue line just shows you the relative performance of British American tobacco to the Aussie. So when the blue line goes down, it means that British American tobacco underperforms. So this period from January 2017 till today, the last 3 years, for 2 years, British American tobacco underperformed because the market focused on all the negatives. Smoking is a dying business, regulatory requirements, new generation products that you're not sure about. We think that it was way overdone, and we bought 1.4% in client portfolios in June 2018. And then, of course, clients said we were wrong, but nevertheless, or people said that we might be wrong. We also thought that at some point we might be wrong. And then the share price fell to 445, and we bought more. So we added 3.5% in the down cycle. Then that was right at the bottom, and the share price started to outperform, and at the moment it probably sits there. So we are simply saying is we had a period of significant outperformance. All the reasons why the share price underperformed in the period July 2017 to January 2019, all those reasons are more or less there. People still smoke less. There's still uncertainty about new generation tobacco products, but there's no doubt that the company still has the ability to generate decent cash flow. So we just trimmed some of it because it's more elevated on a relative basis, the valuation more elevated on a relative basis, and we want to use that currency to buy cheaper assets. We still have 7% of British American tobacco in your portfolio. We still want this share to go up, otherwise we should have 0 in it, but we just think that we can utilize some of the returns that we've made here to acquire assets that are cheaper. Carl, I would like to conclude. I'm not going to go more on that. I just would like to conclude about the whole thing about risk in portfolios. Often clients would argue, and not only clients, it's an argument that the debate that we have within our team. So, Alwyn, why don't we have more gold shares in the portfolio? Because gold should protect you in times of crisis. So it is also a bit of a buffer when things go wrong. Well, I just said, gold, firstly, I find very difficult to value, or we as a team, not I, we as a team find very difficult to value. But if you look at the performance of gold shares versus mining, diversified mining shares, and that is BHP Billiton and Anglos, since 2002, it was one-way traffic. Gold shares underperformed diversifieds, except during the crisis in 2008, and except during the time when commodity prices came under severe pressure during the latter parts of 2015, the early parts of 2016, and of course now. The pattern though was, in the crisis, the gold shares outperform, and after the crisis, they give everything back. In the crisis, it outperformed. After the crisis, it gave everything back. So if you didn't have the gold before the crisis, no need to acquire it during the crisis because the horses normally bolted. There are other ways that I think you can protect. Cash sometimes is a good protection. Bonds, global bonds is the best risk diversifier that any actuary will argue for. We don't necessarily need gold. And I know gold is, again, one of those, you're either gold bull or you're not, but I think we try to look at it scientifically. So I want to conclude. Massive sell-off, economic fallout that we will still learn over the next 2 to 3 months, how that will work globally and probably for the next 6 months in South Africa. Massive stimulus being added to the problem that should arrest the downside. And the question is really, to what extent has that been priced in? We think the price has overreacted, and we think we should add more risk. Do we think that we should add all the risk at one go? No. We think that as the market will wrestle with all the uncertainties, we will on a continuous basis get opportunities to get into the market more and more, and then acquire risk over time that will hopefully be a more prudent way to increase the risk in the portfolios.
Thank you, Alwyn. So to all our clients out there, so thank you very much. I hope you appreciated the presentation. Hopefully we've answered some of those questions that you may have. I would urge you to please pick up the phone and speak to your portfolio manager. Again, from our side, thank you very much. Thank you for this time. We really appreciate your business. We really understand that the difficulties that we're all going through. Hopefully we could showcase to you that as a business, we're open for business. We debate these issues on a daily basis. Our portfolio managers are fully aware of this. So from our side, thank you very much. But the most important thing from our side is please look after yourself, look after your families, stay safe, and until we see you next time. Thank you very much. Thank you, Alwyn.